In the early 21st century, the U.S. housing market began to heat up rapidly. House prices rose year after year. Even average people could easily buy homes. Banks lowered lending standards and issued massive subprime mortgages. These loans were packaged into complex financial derivatives. Wall Street investment banks traded mortgage-backed securities furiously. Credit rating agencies gave AAA ratings to risky products. Investors rushed in. Greed inflated the bubble. Real estate agents and developers made huge profits. Ordinary families took loans to buy second homes. The credit bubble grew larger, and risks quietly accumulated. In 2006, house prices showed the first signs of decline. Subprime borrowers started defaulting on their loans. Mortgage default rates skyrocketed. Banks began foreclosing on homes. The foreclosure wave started. Wall Street still believed the crisis would not spread. In 2007, New Century Financial collapsed first. Bear Stearns faced a severe liquidity crisis. The Federal Reserve injected emergency funds to stabilize the market. Yet panic had already begun spreading through the financial system. In March 2008, Bear Stearns was acquired by J.P. Morgan Chase. On September 15th, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy since the Great Depression. Global stock markets plunged instantly. AIG teetered on the brink of collapse. The government was forced to take over AIG. Credit markets froze completely. Companies could not borrow. Interbank lending rates skyrocketed. Wall Street descended into unprecedented panic. The full-scale financial crisis erupted. Stocks kept crashing. Trillions of dollars in wealth evaporated. Retirement funds and 401k accounts were devastated. Millions of Americans lost their jobs. Unemployment surged above 10%. Home foreclosures reached record levels. Millions of families became homeless. Lines for food stamps and unemployment benefits grew longer. Auto sales and consumer spending collapsed. Companies laid off workers en masse and went bankrupt. The recession swept across the entire nation. The crisis quickly spread to Europe and Asia. Iceland nearly went bankrupt. Greece's debt crisis began to surface. Global trade plummeted. Developing countries were hit hard too. In October 2008, the Bush administration launched the $700 billion TARP bailout. The money was used to rescue banks and financial institutions. The public angrily protested bailout banks, not people. In 2009, the Obama administration passed the $787 billion stimulus package. The Federal Reserve launched multiple rounds of quantitative easing. Interest rates were cut to near zero. The government bailed out the auto industry. GM and Chrysler received aid. In 2010, the Dodd-Frank Act was passed. It strengthened financial regulation and created the Consumer Financial Protection Bureau. Bank capital requirements were significantly raised. Too big to fail, institutions faced stricter oversight. The worst phase of the crisis finally passed. Yet the recovery was slow and painful. Millions of families lost wealth that would never return. Social inequality deepened further. The crisis exposed systemic risks in the financial system. Excessive leverage and uncontrolled derivatives were to blame. Lack of regulation and greed were the root causes. Ordinary citizens paid the heaviest price. The crisis reshaped American politics. The Tea Party movement emerged. Occupy Wall Street protests broke out. Public trust in Wall Street and government hit rock bottom. Global financial regulation entered a new era. Basel III strengthened bank capital rules worldwide. The crisis reminded us, bubbles always burst. Excessive speculation always comes at a cost. Government must act decisively in times of crisis. Yet moral hazard must also be prevented. Today, we are still learning the lessons of 2008. Signs of overheating have appeared again in housing markets. Financial derivatives remain complex and opaque. Regulators continue to strengthen oversight. Ordinary people now pay closer attention to personal debt. The crisis changed the values of an entire generation. From boom to bust took only a few short years. Wealth vanished overnight. Dreams shattered overnight. Countless families lost homes and hope. Yet the crisis also sparked reform and reflection. The U.S. economy eventually recovered slowly. Stock markets reached new all-time highs. Unemployment gradually declined. New financial rules now protect ordinary depositors. History once again proved, crisis brings change. We must remember the painful lessons of 2008. Greed and unregulated financial innovation are extremely dangerous. Regulation must never be relaxed. Protecting ordinary citizens must be the top priority. Every crisis is a test of our institutions. Today we are stronger than in 2008. Yet risks still remain. Let us stay vigilant. Watch for the next bubble forming. Maintain financial stability and protect economic security. The story of 2008 must never repeat. America rose from the ashes of crisis. A new regulatory framework has been built. The resilience and adaptability of the people is admirable. History is the best textbook. We learned humility and caution from it. Prosperity cannot be built on false bubbles. Fairness and transparency are the cornerstones of financial markets. The crisis made us more united. In the future, we will better prevent risks. 2008 will never be forgotten. It changed the global financial landscape, and it changed the destinies of countless people. America that emerged from the pain is stronger. Let us together safeguard economic stability. Beware of any form of excessive speculation. Regulation, technology, and ethics must go hand in hand. The voices of ordinary citizens must never be ignored. The crisis taught us to cherish hard-won prosperity. History does not repeat exactly, but it often rhymes. The lessons of 2008 light the way to the future.